Right, morning, and thank you for joining the webinar today. Listen, February is a tough time. Obviously, tax year end coming up for a lot of advisors, so we appreciate you spending an hour with us. But at the same time, I think with all the sort of noise and market noise that we're seeing, I think it's great to get this kind of intel just before you start going off and speaking to some of your clients next month. Now. I've got a couple of people joining me today. I will cover off a little bit of housekeeping before I sort of do the introductions. So we have sort of mapped out about an hour for this in terms of the webinar. We will try and save you a bit of time if we can, of course. It is going to be CPD-able, so we will provide CPD after a feedback form, which you'll receive sometime end of this week, which is great. There is questions that we will take during, but there is also a slot Q&A panel discussion that's going to be taking place in the last sort of 15, 20 minutes. I will put a note in the Q&A section so you know where to find that. But please do send your questions in. We've had a couple of advisors who have graciously sent a few questions in beforehand, which we'll try and try and cover off. But if we do cover off in the session, if we don't cover off in the session, then we will try and come back to you on that as well. Perfect. Saftar, if you want to just go to the next screen for me, please. And just while we do that, I'll do the quick introduction. So my name is Saad Thind. I'm actually head of sales here at Binary Capital. You might have seen Sam Boughton was due to be host, but I've been sort of substituted in at the last minute. Joined with us, fortunately, is Bilal Hafeez, who I'll do a quick intro for, but no doubt he might do one himself just before his section. So Bilal's joined us as actually founder of Macro Hive, and looking at sort of his expertise previously, he's actually been using the last 15, 16 years or so as a market strategist, global market strategist for Deutsche Bank, in his sort of previous role. And no doubt you might have seen him on Bloomberg, fortunately. But I also found out that he's actually been a professor, having looked at his sort of LinkedIn profile briefly. And I hear a rumor that during Wimbledon, he was also neighbours with Federer. So listen, if you haven't got questions on the market stuff, no doubt you might have questions on the tennis. As well as Bilal, we're joined by our CIO, Saftar Sarwar. He's actually been at Baillie Gifford, at Barclays. He's a founding member here at Binary Capital, as well as giving some of the market update. He'll also be using some of the portfolio construction analysis that a lot of advisors asking questions for. So we'll no doubt dive into some of that as well. Perfect. Sorry, Saftar, if you can go next slide. And just before I pass over to the two of them, I just thought I'd do one slide as a quick introduction to Binary Capital, especially if you haven't come across us before. No doubt most of you have. Now, Binary Capital is a discretionary fund manager, which most of you might be aware of. We haven't included it in the slides, and we typically don't tend to do this, but we do like talking about performance, well, especially I do in the sales team. So as the head of sales, I'm sort of pleased to sort of mention we've got some top quartile, top decile returning portfolios, which is great. But I think it's actually the breadth and depth of our solutions that is quite interesting. Everything from the active to the passive to the ESG range, even a niche sort of Islamic portfolio range that we try and provide our clients. So that breadth is actually what's quite important. But what you can see on this slide is probably what we feel is our sort of core, our sort of core soul of what the company's trying to do, which is all about client centricity. It's all about servicing and how we can actually provide that to our clients. We try not to become a sort of discretionary, transactional discretionary fund manager. We try and make sure that we can actually provide the service that a lot of IFAs expect, but also their end clients. We are fully independent, so we don't have any IFAs that we own. It's very much a case of we only work with independent financial advisors. We don't try and get over to your side of the fence. And in terms of the global outlook and some of the investment stuff, I will sort of leave it to Saftar to go through. But any questions, please put it in the Q&A, or you can speak to me afterwards. So that's a quick 5-minute introduction. I will happily hand over to Bilal.
Great, thanks a lot for the introduction. And yeah, just as was mentioned, my experience is, I previously did work at some of the largest investment banks and now been running Macro Hive. And what I do mainly is speaking to some of the largest investors in the world, hedge funds, asset managers, sovereign wealth funds around the world, to advise them on how to manage their portfolio. So hopefully you'll find, all this quite helpful. Now, there's a lot of noise we've had over the past first 3-4 months with the win by Trump, but I will talk about Trump. But I also wanted to just provide kind of the macro context for things, because I think that in general will inform asset allocation. And then there's kind of a Trump element within all of that, but we shouldn't neglect where we are in the macro part of the cycle. The key thing is, and if you go to the first slide, the key thing really is the inflation picture. So I'm focusing on the US mainly because the US drives the world, and sort of hence sort of the US sort of focus of these charts. So this chart here shows you inflation in the US over the last 20, 30 years. And what you see there is that before COVID, inflation in general in the US was running around 2%, which was the target of the Fed, and it's the target of all the major central banks around the world. Now, of course, we had the inflation surge after COVID, and over the past year, over the past 2 years, inflation did fall, but worryingly, it looks like we haven't fallen back down to 2% yet. It looks like we're settling around 3%. And so it looks like there's dynamics in the economies which is leading to residual inflation. And economists often talk about how the last mile in bringing inflation down is the hardest. But what central banks have actually done is that they've started to cut rates already, even though inflation hasn't fallen back to 2%. And in hindsight, that could well end up being a mistake by central banks by not holding rates higher for longer. And now we look like we're settling at around 3%. Now, why is inflation settling at a higher rate? Part of it is because after COVID, supply chains around the world, there's onshoring, deglobalization's occurring. So there's this ongoing shift in the structure of production chains around the world, which is leading to higher inflation. So before COVID, goods prices, like the stuff, TVs and all these sorts of things that you buy, typically their prices, quality adjusted, would actually fall year after year. Now they're actually rising year after year. So it seems like there's these major shifts in supply chains, which is leading to higher goods prices than we had in the pre-COVID world. The other larger thing is that labor markets in general have been relatively tight. So people generally have kept their jobs, wages have stayed at a fairly healthy pace. And probably the biggest issue with inflation is that housing costs are really quite elevated. They haven't really come down that much at all, whether you're renting, and now obviously with mortgage costs as well have sort of picked up as well. So this is keeping inflation high. And my sense is that we are in this higher inflation regime. And as a result, I think it will be harder for central banks to cut rates. On the Fed, for example, my sense is that they won't cut rates this year. Most people, consensus markets are pricing 2 cuts by the Fed this year. I think they're not going to cut rates this year, mainly because of this inflation problem. And what we're seeing from Trump in terms of tariffs and all these other sorts of things are going to just aggravate this inflationary issue. Now, on the next chart, I just wanted to get a sense of where people are expecting growth to be across the major economies of the world. And what this chart shows you is the consensus of the market for growth for this year. And what you can see is in the orange line that people for 2025 have really been revising up their US growth expectations. So people are very, very positive on the US. Meanwhile, on the European side or Euro area, the same with the UK as well, the blue line has been falling. So in general, coming into this year and into February, people are very optimistic on the US and they're very pessimistic on Europe. And I think this is an interesting dynamic because to me, as a markets person, this tells me that a lot of good news has been priced in for the US side and a lot of bad news has been priced in already for Europe. And so my sense from an asset allocation perspective is that I think that the US risk markets, equities and so on, are likely to disappoint this year. And I think European markets are likely to provide a positive surprise because the bar to have a surprise, and it's really surprises that drive markets in the end, are much lower for Europe. And already with the German elections, we're starting to hear more stories about, Germany may start to do more for fiscal stimulus, more defense spending. We've had the Russia-Ukraine story, which, leaving aside all the politics around that all, if there is some cessation of the war, that in general should be good for Europe. Already natural gas prices have been falling. And so my sense is that huge amount of good news has been priced in for the US, and people are very pessimistic to Europe. So from an asset allocation perspective, I'd prefer Europe over the US. in general. So that's kind of on the growth side. Now, if you go to the next slide, what I wanted to kind of focus here a bit more is Trump. And what I show here is the orange line is how different markets have behaved since Trump got elected in November of last year, compared to sort of the same sort of period in 2016 when he got elected. And what you can see on the yield side, the leftmost chart, is that in 2016, immediately after he got elected, bond yields went up. This time around, it took a bit of time before bond yields went up, but they haven't really stayed up for that long. And part of that is because with Trump 1.0, he immediately announced tax cuts. So that was a big increase in the deficit. This time around, he's not necessarily announcing additional tax cuts. Rather, he's announcing that the tax cuts that will expire by the end of this year will remain in place from 2026 onwards. So it's not new tax cuts. It's more like a continuation of existing tax cuts. Plus, there's been a lot more talk about bringing the deficit down and lots of squabbles in Congress around that. So bond yields haven't really gone up as much as they did in Trump 1.0. That's an interesting sort of development. On equities, stocks are not performing as well as they did under Trump 1.0. And I think part of that is to do with all of this tariff talk. I think part of this also is linked to some of the weakness we're seeing in tech, which I'll talk about in a moment. Then on the dollar side, the chart on the right, there's more of a parallel between the two, where the dollar went up after Trump got elected, same this time around. But now we're starting to see over the past month or so some significant dollar weakness, especially against the Japanese yen. But even the pound, the euro have kind of been grinding higher. So it looks like a lot of, sort of dollar strength has stopped. Now, on the equity side, if you go to the next chart, ignore the title of this slide. I was playing around with some of their ideas first. But if you look at the bar chart on the left, what I've done here is I looked at the US stock market and I looked at the largest cap stocks. So the 1 percentile stocks, how they perform versus the next 5 percentile and so on. So the S&P 500, I split it by market cap. Last year, in the last few years, what you found is the top 1% of stocks have delivered all the performance for the US, the so-called Magnificent Seven. You know, the Nvidias, the Teslas, the Alphabets, the Amazons, and so on. Interestingly, this year, the Magnificent Seven, the top 1% have done quite poorly. They've only delivered a 1% return so far this year. Actually, probably 0% since I've updated since this slide came out. So essentially, Mag 7 have done quite poorly this year. Why is that? I think it's not so much to do with Trump. I think it's more to do with the fact that we've had the DeepSeek story that came out from China, which essentially changed the whole dynamics of the AI story, where suddenly number one, you have a non-American competitor coming into the picture. So suddenly it shows you it's not just a US story, the whole AI story. Number two, what DeepSeek did was it showed that the training costs and the inference costs of running these models can be way, way lower. And so suddenly it's introduced a price war with all the US AI models. So for example, we use a lot of AI models within Macro Hive, and immediately our cost just went down. OpenAI basically reduced its cost of running their models, which we do all the time. So every time you ask a question to ChatGPT, there's a cost associated with that. They've had to push it down, and I think that's taken a lot of the froth away from the tech story in the US. Then there's a specific Tesla issue where what we're seeing is, and this is where politics gets involved, is that because of Musk's prominence now and his sort of political personality, he's becoming way less popular than he was before. And as a result, people are buying less Teslas. So yesterday we had European data for January car sales in Europe. And what we found was there was a 50% reduction in Tesla purchases in January compared to a year ago. So Europeans essentially have stopped buying Teslas. And a big part of that is because there's been brand contamination from Musk's association with Trump, and also the way he's behaving in general. So Tesla's struggling in sales now because of that. So So because of this, this is another factor why the US to me looks less interesting. Number one, people are very bullish on the overall US economy, so that's priced in. And then number two, the very specific, unique US story, AI, is no longer delivering you the equity returns. Then the chart on the right shows you, if you go back, the chart on the right essentially shows you the performance of stock markets around the world year to date. And usually the US is at the top of the pack. This time it's not. It's at the lower, it's kind of the middle of the pack. Instead, Germany has done really, really well, which I think is to do with the fiscal story, the elections, and so on. Hong Kong's done very well because there's been a lot of interest in buying China tech in the Hong Kong market, Italy, Spain, Korea, and so on. So essentially, the rest of the world's doing better than the US. So I think this is a big story. I think this will be the story for this year as a whole. Then finally, on the dollar, if you go to this next chart, so one thing that, in addition to this story about equities doing better in the rest of the world than the US, and that being a reason for the dollar to go weaker, if you look at a long-term chart of the US dollar, what you find is that the dollar is trading at very, very high levels. So this is a chart going back to the 60s. And you can see that inflation adjusted, the dollar is trading at very, very high levels. It's higher than where it was in the year 2000, when the dollar last saw a major peak. Only in the mid 1980s was the dollar higher than it is today. Back then it was around 5 to 10% higher. So we're kind of on the dollar side, we're very, very stretched levels. So my general bias on the dollar is to be underweight the dollar. So to be underweight the dollar, overweight the pound, overweight the euro, overweight the yen, and so on. Even if other countries have problems, the dollar is a dollar side of currencies that drives everything. The other side for the currency is less important. So when the dollar turns, it turns against everyone. And so for me, my bias in general is to kind of scale back in being long dollars. Over the last few years, I've been very bullish on the dollar, but now I'm switching my sort of tact now. So what that means then is if you do have like US holdings, for me personally, I'd start to consider introducing either some currency hedges in the expectation that the currency side won't give you that extra kicker on your US holdings than you had before. So I'll stop there now to hand off to Saftar, and then maybe we can take questions later as well.
Yeah, thanks for that, Bilal. I hope everybody can hear me. And a couple of things before I start. Firstly, I'm not Sam Boughton. I'm Saftar Sarwar. I'm just sitting on Sam's PC. He's my colleague, very, very good colleague, been here from the start, as I have, at Binary Capital. And yeah, thanks again for Bilal for his intro and overview. Bilal's a very, very experienced macro and micro strategist, and certainly his views are very compelling in what he said so far this morning. And I welcome you guys to certainly ask any questions you have of me as I speak in the next for the next 10 minutes, or even Bilal as we come back and have this kind of discussion in the second half of this webinar. So yeah, so let's touch on Binary Capital and certainly our thinking on a macro and investment perspective for this year. Perhaps touching on some of the points Bilal made as well. As I said, I'm the CIO, ultimately have oversight over the investment strategy. Many of you guys know me, many I've met, many I haven't. We've been running money now as an independent investment shop for 6-7 years now. Pleased to say, very, very strong performance over that time period in the main. So I'll give you some macro. I've got a lot of slides here, but I don't think I'm going to touch on all of them, so I may rush through them. But again, through Sarb and his colleagues, they'll be available after this webinar as well. Certainly from our perspective, while we take a macro view on things and take note of Bilal, his colleagues, and others in the market, fundamentally, we are bottom-up investors. We like to take our time investing. We're fairly patient in our approach. For example, we rebalance typically every 6 months. Some people, our competitors, do that more frequently. And I know everybody talks about it. We generally take a long-term view. Our turnover is circa 10% or so. So very much long-term. So we've had growth shocks in the past, whether that was last year or the year before, and we've managed through that. Even to an extent, I think it was last August, there was a bit of a shock with Japan and so on, and NASDAQ came down 10% or so in the first couple of weeks of August last year, but equally it bounced back up again. Because another thing that we take a lot of pride in, or is trying to understand, is we don't typically have interest in or timing in the market. We don't really think we have a competitive advantage, so we try not to play that game if we can not do so. Hence the kind of long-term focus. So some key themes still running through our portfolios just now that we are very comfortable with, but certainly noting what Bilal says, as your year progresses, that may or may not change going forward. We have that international outlook that we've always had away from a kind of UK home bias. So certainly, typically, we've got a large allocation to the US. As we all know, the US makes up often 60, 70% of the global index. So one has to be in the US. And certainly that's played out really well over the past 10 years, if not even longer. So we still have a large allocation to the US. And I would guess we're probably market neutral to the US as we speak, not overweight at all. And certainly more inclined, similar to what Bilal is saying, looking at other markets, where that's emerging China, as well as Europe, clearly seems to be very compelling, certainly in the short term as well. But I'll touch on maybe some of the longer term aspects of that. And we still certainly on an emerging markets context, we actually added to that more recently in many of our portfolios. We like the technology story. Bilal touched on it. DeepSeek certainly came out the blue, albeit it's been well known for a few months prior last year as well. And that kind of ignited the whole kind of China tech theme that's been in a bit of a doldrum more recently. Even Alibaba has been rising significantly year to date as well. And that could have longer term implications for China as well as Asia generally in that space. Certainly something that Bilal mentioned as well. We like the population growth. We like the middle class consumer story. Again, some of these points are well known as well. This year, again, we see more volatility in fixed income. Again, highlighting what Bilal has said in terms of interest rates, persistency of inflation that seems to be stickier now before it goes down to the central bank levels that they seek, where that's here in the UK, certainly in the US as well. And also the deficits that we're seeing as well, that needs to be tackled. Certainly the Labour government tried to tackle that in its budget, and Trump may have to tackle that sooner rather than later as well. So certainly inflation, some of the rhetoric around the geopolitics could be also inflationary. There's elements of that maybe creeping in already, or certainly expectations of that. So we're cognizant of that in the way we manage portfolios from a macro level. But I need to stress again, we're very much long-term, certainly from a bottom-up perspective. Again, well-known charts, US. There's two views on the US that I'm going to touch on very, very quickly. Obviously, US valuations are expensive, well-known, looking at any multiple, price earnings, clearly a popular multiple, expensive relative to its history, relative to the dot-com bubble that clearly burst over a period of time as well. And certainly from a global perspective, compared to other peers, the US is expensive. In saying all of that, I could have said that I could have made the same point last year as well, and even probably the year before. So it's been expensive for a while. And that goes back to the point about maybe Bilal will have a view on that later on in this conversation about US exceptionalism, that kind of narrative about the US economy as kind of decoupled from global economics in terms of the way they are, whether that's through big tech, whether that's through its workforce, its labour market, its exceptionalism in entrepreneurialism and so on. And that's clearly been a factor, or certainly a point that many people have made. Even this kind of whole AI story, notwithstanding DeepSeek, the fact that the US is seeking AI competitive advantage against everybody else, and perhaps will do whatever it takes, may also be interesting long-term for that country, and potentially as a deflationary force as well going forward. It's something that we need to be mindful of. And again, the point here made around US economic growth and certainly US earnings and so on, and obviously equity returns over the last period of time. And it would have been a mistake to have missed out in such earnings. And as highlighted, a lot of those earnings are coming a very narrow cluster point made by Bilal really well, so I don't want to dwell on this too much, but is the end of mega cap or certainly tech or large cap or that cluster over? To be seen, who knows? But certainly there's interesting movements in markets. Meta's done well really so far this year, but beyond that, others have underperformed or been negative. And as Bilal highlighted, Tesla has been a bit of a laggard, having had a strong run up post the Trump election in the last 2 months of 2024. We like emerging markets for many reasons. Primarily, it's focused around China and India and other areas as well. And so we think that could be a compelling theme as perhaps investors diversify away from more expensive markets. So interesting from a commodity perspective, valuation perspective, and things I've touched on, population growth and so on. I think volatility in fixed income will remain. Bilal's mentioned that he doesn't expect to see the Fed dropping. There's even comments about the Fed having to maybe revisit and increase interest rates or marginally even this year to stave off inflation. At the same time, if you have fairly benign or low economic growth, again, there's a narrative around stagflation and things like that coming into pass. Again, keen to hear people's views on that, as well as Bilal's maybe at the end as well. But certainly bond market volatility will be expected. We, as an investment house, are fairly neutral in that. We take a fairly kind of average duration approach to markets. We don't take excessive risks in fixed income markets per se. We see ourselves very much as equity specialists, so we want to get that return from equity markets generally. Again, touching on some of the investment themes now very, very briefly for the next 5 minutes or so. I put this slide up there because we want to think like the best investors. How do the best investors in the world invest historically, now, and going forward as well? And how do we take inspiration from that and validate what we do at By the Capital in that approach as well? So we very much see it from that lens, the way we want to manage DFM monies, the models and the strategies we do for you as clients or potentially as clients going forward. What we seek is getting that asymmetrical return payoffs. A lot of people talk about it. It's very, very hard to get in reality, but certainly something that we seek persistently in many of our active strategies, i.e. an ability to take risk, but not excessively so, for genuine long-term upside returns. Where that comes from growth markets, core equity markets, the US or elsewhere, we try and seek that very much so. So therefore, our returns over time will certainly outweigh any losses we have in any portfolios at any one point in time. Very important slide. And this slide is probably the most important slide I'm going to touch on in this presentation. It seems to be quite a busy slide, but I'll summarize it like this. Academic research has validated over the last 40 years, if not longer. Say there's 100,000 equities in global stock markets, roughly speaking. The returns, the excess returns you get over and above fixed income comes from a very, very narrow equity base. Very, very narrow. More or less 1% of those equities will produce those returns for investors over a time period. The rest of those equity returns, that 99,000 or so, will produce negative returns or returns similar to the fixed income strategy. So our job is to seek those managers, those strategies that gets that 1% outlier returns. Bilal mentioned it somewhat, and we know ourselves, whether that was the Magnificent Seven, the tech phase that we had in the US over the last 10 years, where it's some emerging market growth stories, the China story that may be bubbling up again as well. But certainly seeking the best companies, and how do we get the best managers out there that can capture those returns? And those returns, that 1% return on the far right, moves all the time. It's not static. So where is that not going to now historically, but where is that puck moving to in some respects? That's what we seek as well, and that's what we're always trying to validate in our strategies, trying to get the best, whether that's the growth managers, growth strategies, or even value or core equities as well. So far, we've had that from US equities. It's been a major return generator. It may come to pass. That doesn't happen going forward. It remains to be seen, but it's certainly one that we're certainly fixated on just now. I touched about investing in the future, some stocks that we like, looking at disruption in that respect as well. But for us, it's not all about growth. We believe in that kind of more balanced approach to investing. While we have a slight growth bias to investing, we still take a risk management approach to the portfolios for clients. This is one classic example. In our active balanced portfolio, we have fixed income, we have a equity allocation, as you can see there. But I've kind of highlighted that we have a very large allocation to alternatives, absolute return strategies, EQR, to give you one example, Fulcrum that we know really well in London as another example, Troy Asset Management we know really well. We utilize them as well. They've got allocations to gold amongst other areas. So what we do is we might take that growth bias or that growth focus in our equity allocation, but then that is offset with some of our alternative bucket, kind of almost like hedged out. Some of the stuff Bilal talked about, whether we need to hedge currency risk, FX risk, and so on. So therefore, clients get a really nice risk-adjusted approach to the investment journey over a time period. They get the best of the equity return, and then they get the best of some of the opportunities in the alternative and fixed income space. So if equity markets come off, as they have been doing over the last week or so, if not longer, you're still getting stability of return. Hence the reason some of our active portfolios, our core portfolios, are certainly top decile year to date, +4, +3.5% as we speak today. Example of returns last year in terms of our return profile, again, historical data, but just an example there. In our passive, we were +16%, top 6 out of 240 in the peer group. The numbers are the numbers. Don't want to kind of dwell on it too much whatsoever there, but I think we know the story for our performance certainly last year, and we're fairly confident that we can continue that this year, albeit you may see the returns coming from more of the active and the core portfolios as opposed to pure passive. Bearing in mind what Bilal has said, these kind of shifts that are happening in markets that may be longer term in nature, more secular, as well as the geopolitics that are also taking place as well, that clearly have market impact, Russia, Middle East resolution as well as the Trump and the three kind of powerful leaders now out there, Putin, Xi, and Trump now kind of more or less trying to carve up the world as they kind of see it. Our outlook view is, in terms of an investment perspective, that narrows of returns I touched on in this slide will persist, albeit it'll shift into potentially different equity markets, equity returns there. But they'll persist. We still see opportunities globally. We're not getting too stressed about this sell-off that's happened more recently. We've got NVIDIA's results this evening. Let's see how that develops as well. We're long-term investors. We're not going to panic out of a short-term trading downward trend. We like to invest like our underlying clients invest, 5, 7, 10-year time horizons. At the same time, DeepSeek AI is evolving. It's going to be a generational opportunity. It could be deflationary. Other investment opportunities will pop up. We need to be mindful of that and then take advantage of that as well as one can. We're optimistic. We're not going to get stressed out, depressed by any short-term correction or even a bear market. And fundamentally, our tagline is we want to become the best growth-focused DFM in the UK out there. We're humble to what the markets tell us every day, but certainly something that we endeavour to do so for ourselves, for our investment portfolios, and ultimately for our clients as well. So on that kind of quick whiz through, what I'm going to do now is invite back in Sarb and Bilal, and we're going to now cover off a kind of hopefully 15 to 20 minutes Q&A session and discussion around points that are relevant in markets and so on, family as well. Sarb, over to you now.
Perfect. Thanks, Saftar. Appreciate that, and thank you both for that update. Please, before the advisors on the call, please do add into the chat in the Q&A section. But we do have a few questions from advisors, as I said previously, and I think we've got a couple in the chat now as well. I will wrap some of them up together because we've had quite a few that were sent in before. One of the key ones that keeps coming up is the US. Now, there's a couple of questions regarding this, but I wanted to take on one in particular, which is the tariffs that we keep hearing about, both tariffs facing out of US into places like China, but also I think, Bilal, you mentioned Europe in particular. So do you have any sort of thoughts between the two of you in terms of those tariffs in Europe? And do you think it would impact some of the growth that you yourself mentioned, Bilal, that could happen in Europe itself?
Yeah, I mean, I think on the tariffs, it certainly seems like Trump is going to be much more aggressive on tariffs compared to his first administration. In the first administration, what we found was that he focused more on sector type tariffs, like on washing machines into the US and aluminium and those sorts of things. And he also back then showed more willingness to compromise as well. This time round, it seems different. He's already imposed 10% tariffs on China. They're likely to increase. And I think it does seem like he wants to impose tariffs on pretty much every country around the world, including Europe. So Europe will end up with tariffs, like universal, like tariffs across the board, not just on specific sector. So this will be a net negative for especially manufacturing related names and commodity related names. They will be impacted by this. One interesting feature, I think, is that if you look at the way markets have been responding to tariff news, it's been much less than it was in Trump 1.0. So it does seem like there are a lot of adjustments in market prices have already happened. So what this means is that while there will be a negative impact on especially manufacturing type names, it may not necessarily be as bad as it would first appear because the markets have already got some kind of risk premium around that all. Moreover, if we look at the characters you have in the administration, whether that's Scott Bessent, Howard Lutnick, they all seem to be pushing for a market sensitive approach to tariffs. So it seems like every time Trump does go aggressive, they do kind of pull him back a bit to say, okay, let's defer by a month. Let's do a gradual tariff, 1% a month, and those sorts of things. So that should ease things. Now, the potential wildcards here are how countries will respond to the US. So the Europeans, what will the Europeans do? What the Chinese have done is they've imposed some tariffs on the US, but fairly narrow. So they're trying to de-escalate. The question with Europe is whether they whether given what's happened with Russia, they escalate. The way they could do that is they could introduce some kind of tax on US tech companies into Europe, on Facebook and all of these sorts of names. And then they could also potentially attack the US, all the tax locations that tech companies have in Luxembourg and Ireland within Europe. So the question is, do they want to escalate against the US? So that, for me, that's the wild card, the European reaction to it.
Got you. And just Bilal, just on that, and I'm just thinking of another point with Trump, and obviously you mentioned the tariff sort of going back towards him. Do you think there's less concern from the US because of some of the other trade deals they're trying to create? And I think I read something that Ukraine had 500 billion pound resources, and they're trying to now do a deal in terms of that resources for the US to actually impact. So do you think that's more of a focus for Trump rather
I think
this tariff
that the mineral rights thing is separate to all of the tariffs. I mean, that's more to do with the US perceives that it's put a lot of money into Ukraine for the war and they want something back. And they're basically saying, look, whatever minerals Ukraine has, that's collateral that the US will be able to get access to. So that's sort of independent and separate from the tariff story. What I do think, one thing we have to remember about the US is the US in general is a relatively closed economy in the grand scheme of things. They've got a massive domestic market. So although tariffs will have an impact on the US economy, there's such a massive domestic sector, it won't derail the US tariffs by themselves. Other countries that are very sensitive to trade, like China, for example, is very reliant on trade. A lot of the Asian names are reliant on trade. That's where Canada is. That's where you see some sort of pressure. So there is that sort of dynamic. The larger thing I think in Trump's mind is that he views tariffs as a potential tax revenue that will reduce the fiscal deficit in the US. Now that is, I think, an area that he misunderstands, that I think that you can't raise that much in tariffs to offset the income tax cuts. He talks about in the 1800s under McKinley and Jackson, you had tariffs were the main revenue generator for the US, but that was back when the federal government wasn't that big. The US government didn't provide anything for the people. There's no way tariffs can replace income tax and things like that. So I think that's going to be something that we're going to have to sort of see how that unfolds.
Perfect. Saftar, moving on to you. I suppose keeping into that sort of US theme, I think one of the questions that came through was looking at more binary capital, and that we seem to be taking more of a market neutral approach to the US, because I think historically we have been slightly underweight probably predominantly underweight the peer group. That's coming more neutral, but when Bilal's talking about, and you yourself are talking about sort of prices and how the US is sort of priced, and potentially Europe sort of more, a bit more price sensitive to more of an upswing. What do you think the sort of thoughts are? What and why sort of more into the US at the moment?
Yeah, I think it's a fair question, Sarb. What I would say there is the decoupling scenario, US vis-a-vis Europe, or even other markets, whereas Asia and others, has yet to be seen. We've seen evidence of this happening in the past. Whether that will continue, I'm not sure. As you said, we are neutral, the US, because it's a market you can't ignore. When I say we were marginally underweight, so we're neutral, we're maybe tipped it up by a couple of percent more recently. And bearing in mind, that's been in more so core US equities. I wouldn't say we are significantly overweight US tech or US ultra growth per se in terms of the Magnificent Seven or others, because certainly the managers that we'll be speaking to have themselves pivoted or deviated or moved away from some of the bigger names. Nvidia, for example, we know many have been selling out, whereas this time last year or even just before Christmas, doing so. So we're quite comfortable with that. Short term and long term, we may underperform this quarter relative to our peer group. So far we haven't, because I was looking at the numbers this morning, but we're quite comfortable in doing that. That's elements of good portfolio management in some respects, and good risk management as well. In saying all of that, longer term, if we think there's a genuine secular shift away from the US into Europe, UK, on valuation grounds, amongst other areas, economic factors and valuation grounds become compelling, and naturally we will do that shift. We will make that change, but it has to be compelling for us. So far, I have no reason to see that, notwithstanding what Bilal has said so far, and then we will do so if one needs to do so. We have that capability to do that.
Perfect. Moving slightly on to, I think we've spoken about a lot of the positives that can happen in markets, and we've had a couple of good years that obviously clients and advisors have felt. More looking at the potential down risks that may occur. I think, Bilal, you mentioned the last mile in that sort of inflation reduction is quite an important one. So I was going to ask more around, what markets do you think clients need to be either wary of, or do you think that we're going to have more? Do they think especially with their clients, do they think they need more protection this year than they probably have previously, where you've seen large growths in not just Mag 7 and tech stocks, but US in particular?
Yeah, I mean, I think for me, there's a number of sort of major risks that could unfold over the course of this year. Number one is on the inflation side, that if inflation does stay at the current levels, or if not picks up, maybe because of tariffs, maybe because of inflation expectations picking up. Recent US surveys show that consumers in the US have ramped up their inflation expectations. So if that sort of feeds into workers then demanding higher wages, you end up in this kind of wage inflation spiral, which is sort of problematic. Then what that would then lead to is, number one, it would lead to bond selling off. So suddenly your bond holdings become problematic, and many investors have been buying bonds because the yields have been attractive. Suddenly, if you're in an environment where bonds start to sell off, your bond allocation comes under pressure, at least from a mark-to-market perspective. So that's one risk. A related one then is, if that forces central banks to hike rates, then that will start to eat into equity allocations as well, because suddenly you're in an environment where, let's say, growth is soggy, it's not necessarily turbocharging, you have kind of this stagflation bias, and the central bank has to hike rates. And when we've seen episodes of that over the last few years, what we've seen is the equity sell-off as well. So you end up in this worst case scenario of bonds and equities, everything underperforming. And in that scenario, cash does well, but that's kind of the worst case scenario. So that's one major risk, I think, for this year. Another risk I think is China, where there are some positivities around China, but at the same time, a lot of Chinese growth has been reliant on trade. They have started to introduce measures to stimulate the domestic economy. Now, if they can't do that handoff well enough, and if the US does go even more aggressive against China, then that could put China in a very difficult situation. So there's kind of lots of delicate dynamics around China right now. Now, the base case probably is that China should be okay, but it does look like Trump is really trying to be aggressive around China. One theory around why he's being so supportive of Russia is that he wants to peel Russia away from China, so that China doesn't have any major allies anymore, and so then he can target China. So that's one. Then the third one is, and this kind of harkens back to the COVID period, is that we have seen a spike in avian flu, bird flu in the US. At the moment, it's mainly impacting livestock. So as a result, egg prices have shot up. There has been some transmission from animals to humans, so mainly farm workers, but there hasn't really been human-to-human transmission. But nevertheless, there are spike in cases occurring across the US. So if there's some variant in that, and that if that was to kind of start to sort of pick up, then we have another pandemic dynamic at the same time as the US, the Trump administration essentially is defunding anything related to pandemics. They recently sacked all the bird flu scientists recently, and so on. So suddenly you don't have that capability there. So that's more of a black swan type event, whereas the first two are kind of a bit more in our normal macro wheelhouse.
So Safta, with those sort of headwinds potentially, and I'm probably looking at more the portfolio construction, how do we then protect clients on a couple of good years, but how do we make sure that we're protected for that going forward?
I think what we do there, and I take what Bilal's points. Our key risk this year is clearly that inflation, where that remains persistent, maybe even increases around certainly fixed income story, equity, then market sell off. We've had two really good years, surprisingly good years in equity returns, and whether it's a deviation from that on that interest rate expectation cycle, our view is potentially we may not get a rate drop this year as well to some extent. So you're right, how do we navigate that? To be honest, we've already been working, we've done a lot of work on this for the last 3-4 years, bearing in mind what happened in 2022. So the point I made during my talk was around, we have a large allocation to almost like hedging strategies, absolute return. So in any market scenario, if there's a large drawdown, certainly that portfolio should be fairly well protected in terms of returns, as well as the fact they've still got some upside, whether that's in core equities, maybe some value, maybe some commodities, oil and gas, and so on as well. So certainly, I would feel that relative to other strategies, long only passive strategies or long equities per se, should do well in this scenario, and maybe even this year, generally speaking. And we've seen evidence of that. Our core strategies, our active strategies, have done better than our passive. So this seems to be a kind of passive indexation shift to more active managers or active investing that has done well this year, bearing in mind what we just talked about for the last 50 minutes, i.e. geopolitics are so volatile now. Trump says something this week, next week, as we speak, or in the next couple of hours, Stammer's flying over to meet him tomorrow. Let's see what he's already preempted that with his announcement on the defense spending against aid. So let's see what comes from that. We had Macron earlier on in the week. So there's a lot of noise, and that noise is clearly deviating as well. So if you had to pin me down, I think our core strategies, core equities will do really well. Core portfolios will do really well this year, relatively speaking, as well as on their own merits, absolutely as well.
Perfect. Probably the unless there's any other questions, probably the last one that I've sort of just put a couple together. Moving away from sort of the US and Europe, and Bilal, keen to get your thoughts before I move on to you, Saftar. Russia, Ukraine. I think I'm more probably talking more around the energy sector because I think a lot of the times clients themselves, so the actual end consumers here in the UK, are feeling the impact of energy prices and energy hikes and all the rest of it. But if we do see a de-escalation, then in that sector, do you think that will filter into the markets sort of this year, to people's pockets basically?
Yeah, it's a good question. I mean, I think already we are seeing nat gas prices are falling. So there's a general market move in nat gas prices that will feed through to the consumer. At the same time, though, I think even if there is a ceasefire of some kind, I think it'll be very difficult to see Europe re-engaging with Russia to get their energy, from Russia. I just think the politics are making it more difficult. At the same time, at the margin, though, things like, the ability to for Russia to transmit energy to other parts of the world will be easier than it was before. I mean, at the moment they are distributing their gas and oil around the world, but it's been done in kind of all sorts of indirect and sort of backdoor sort of routes. But it'll be easier for them to do that, especially to Asia. So I think at the margin it will have an impact of lower prices, but it won't necessarily be as dramatic as the pipelines opening up again between Russia and Europe. So Europe is having to restructure its energy grid, around that all.
Perfect. And then with that, Safdar, the reason why I've come to you on that is sectors. I suppose when it comes to model portfolios, and you said you bottom up, do you isolate sectors in this sense, either to add some defensive nature to the portfolios or look at sort of opportunities when you do that 6-month rebalancing?
Very much so. We are bottom up. We are, I guess, the term is we're thematically focused. Clearly, the themes that have worked for the past few years with us since the inception of binary has been really technology has worked well, growth has worked well, consumer cyclical has worked well, luxury goods, whether it's China, European spend, has worked well. And so some of that may pivot away to some other areas, whether it's energy and so on. So we may well change that. But I think from a long-term secular basis, let's take a 10-year view on this, because timing's very difficult. I think tech, AI, and I'd be keen to know Bilal's view on this longer term. We think there's still very, very compelling themes, very, very compelling sectors, whether it's big US tech, whether it's China coming back into space, into play here with DeepSeek and others. They've got very compelling monopolies, very compelling margins, strong cash flows, acquisition opportunities as well, buying in smaller companies. We're also very, very positive on healthcare. Again, longevity, we talked about it earlier, longevity issues, emerging markets, spending, hopefully in healthcare, notwithstanding what could happen in the US. So longer term, we think they're very, very compelling shifts that clients, investors need to be aware of, and bearing in mind, you need to still invest in the right stocks. Going back to that point about the top 1% is the only investable universe one should be focused on. Do you have a view on that, Bilal?
Yeah, sure. Yeah, I agree totally. I mean, my kind of take is on the next 5 to 10 years, there's a number of sort of mega themes that are running. One is this whole AI revolution, which is transformative. It's like it's like the internet era. This is like just a complete re-architecting of the way things, work. And the US is a leader in this field, the US companies. And importantly, the thing I like about the US is that there's a number of different companies that are using different approaches to tackle AI. So, for example, you have, Facebook, which has gone down the route of more open sourcing some of its tech. You have OpenAI doing its thing. You have XAI through Twitter, basically going down a different route, like ultra fast, less filtered, AI sort of path. You have Microsoft now, which is kind of the grown-up way of dealing with it, where Satya Nadella sort of recently talked about how they're not necessarily going to invest as much in hardware, they're going to lease more. So you have, that sort of approach. So, between the US companies, you have enough to kind of capitalize with different paths. When you look at, say, Europe, they're just nowhere in that space. So on a 10-year basis, US will lead that pack. And then if you lead the AI pack, that has a knock on to the pharma side as well in terms of innovation around AI, pharmaceutical breakthroughs and so on. So for me, 5 to 10 year, you want to be in the US. The US will be the leader of the pack. And importantly, what you find in the US also is that the performance of these technologies and so on gets captured by equity holders. Whereas in Europe, often they don't necessarily get captured by equity holders. It gets captured by, workers, maybe in higher wages, or by the state and so on. So, in some senses, the US is a bit more capitalistic. If the innovation gets captured by the private sector and the shareholders. So in that sense, the US has that sort of cultural attribute to it all. And then at the same time, the US, China's on the other side of that. China's just highly innovative in various different verticals. So China, US, I think, are the two players. Europe is a wild card here on a secular basis. Whether they can go down the route of what Draghi essentially did. Draghi wrote a paper last year on what reforms Europe should do. Things like capital market union. Where basically you harmonize all the capital investment. Promote like a VC sector in Europe. I mean, if Europe does all of that, then Europe could suddenly become a compelling both value and secular play. But that's big uncertainty, I would say, right now.
Perfect. Just because you've both mentioned AI, and a lot of the advisors on this call will be adopting AI into their businesses. I suppose, Bilal, just for you, because you mentioned that you're utilizing it from a research perspective, that's probably not something a lot of the advisors will get exposure to. Of how does a market strategist use AI, and how does that influence
sure.
your advice? Yeah.
Yeah, sure. I mean, we use it in 2 or 3 different ways. One is we've developed our own chatbot, our own co-pilot, where what we do is we use ChatGPT as the foundation model. Then what we do is we add our own data and resources on top of it. So when we ask it a question, or when our clients ask a question, it goes to our sources to answer those questions. So in some ways, what we're doing is we're using the language capabilities of ChatGPT, but we're using the memory bank of our own trusted sources of research, whether it's our own research, whether it's external research that we trust, so that if you ask it a question like, what will be the impact on tariffs, it will go to our sources to answer that question in a very easy format. So that's one thing we've sort of developed and built, and it just makes things a lot easier and quicker, and you can personalize your responses to your personal needs. Another thing that we've done is, and this you've seen this a lot in the equity sector, where people use AI to read earnings statements and earnings calls. We're doing the same, but for central bank speeches. So when Powell speaks, we have an AI model that reads the speech and says, is it hawkish or dovish? It does it with all the other central bank speakers as well. And we create like indices to see, okay, are they generally becoming more dovish, more hawkish? Is that in line with interest rates and so on? So those are 2 clear things that we're using AI for that we found to be very powerful.
Perfect. No, very useful. I've never come across that, so no, perfect. Well, thank you everyone for joining. I will, as I said, come back to you with some CPD. Saftar, I don't know if you want to say some final comments before we
No,
wrap up.
I think from my perspective and Sab's on behalf of Bounty Capital, thanks for everybody in joining this morning. Pleasure to have you all online. Any questions, please feed them back to myself or certainly Sab in the first instance. And any points about from Bilal's perspective, again, we'll happily take them and then feed them back to Bilal. Again, from my and our perspective, Bilal, thank you as well. I know you're a very busy guy. Bloomberg and everyone else. So thank you again for spending some time with us and our clients or potential clients and giving us your valuable insights this morning as well. Very much appreciated.
My pleasure. Happy to be on.
Okay.
Thank you.
Thanks again, everybody. Thank you. Bye.